Robinhood stock is surging. I mean, it's up over 13% today alone.
Which is just wild to watch in real time.
Right. But, when you zoom out and look at these shares jumping 25% in just 5 trading days, you really have to ask yourself a serious question.
Yeah, are you looking at a massive structural breakout
Or are you walking straight into a perfectly disguised value trap?
Exactly. And that is, that's really the definitive tension in the tape right now. I mean, the charts are undeniably bullish on the surface.
Oh, absolutely.
But when you actually look at the underlying mechanics, the valuation models, the insider flows, the picture gets incredibly complex.
Welcome to the Deep Dive. Today, we are tearing into a massive stack of source material regarding Robinhood Markets, Inc., ticker symbol HOOD.
Good old HOOD.
Yep. It is April 16th, 2026, and our mission today is to cut through the noise of this buying mania.
There's a lot of noise.
So much. We have financial data, technical order flow, and a major SEC regulatory shift to unpack. We really want to figure out where this asset is actually headed.
Because, look, the market is currently pricing in a fundamental shift in Robinhood's operating reality.
Right.
But, pricing in a shift and actually realizing the revenue from it, those are two very different things.
Definitely. Hey, quick note before we get into the weeds. If you're watching this deep dive on YouTube, make sure to like the video, hit that subscribe button, and it is absolutely compulsory that you leave your feedback in the comments. We want to know where you stand on this debate.
For sure. It's a divisive one.
So let's start with that operating shift, because it is the main catalyst driving this entire 5-day run. The SEC has officially removed the $25,000 pattern day trader rule. The PDT is gone.
Gone entirely. And we really need to understand the mechanics of why this changes the game for a broker like Robinhood.
Yeah, break that down for us.
So under the old regime, if you had a sub $25,000 account, you were locked out. You couldn't make more than 3-day trades in a 5-business-day rolling period.
It was basically a strict speed limit.
Exactly. A velocity limit on retail capital.
Yeah.
By stripping away that rule, the SEC hasn't just, allowed more people to trade.
They fundamentally multiplied the frequency.
Right. They've multiplied the frequency at which existing capital can actually move.
It's like, it basically turns a 1-lane highway into a 12-lane Autobahn for retail order flow. I mean, if you have a $500 account, you can now cycle that same $500 through the market 20 times a day if you want to.
Which feeds directly into Robinhood's core revenue engine, right? Payment for order flow.
The FOF, yeah.
Robinhood's top line isn't really driven by the size of the accounts holding the equity. It's driven by the sheer volume of transactions they route to the market makers.
Right, the churn.
So when you take millions of active retail accounts and give them the regulatory green light to trade infinitely within a single session,
And the volume just explodes.
exponentially,
Yeah.
it's an immediate, direct injection into their fee-based revenue streams.
I see the logic there, but, and tell me if I'm wrong here, doesn't that inherently mean those same retail traders are just going to churn through their capital faster?
Oh, absolutely.
Like the more you day trade, the higher the probability you blow up a small account.
Yeah.
If Robinhood's users burn through their cash, that exponential volume spike is going to flatline pretty quickly, right?
That is the midterm risk, 100%. I mean, Robinhood captures the spread regardless of whether the user's trade is profitable or not.
Right.
But they do need that user to survive long enough to keep trading tomorrow and the next day. However, the market isn't pricing in the midterm survival rate of retail accounts right now.
No, it's just reacting to today.
Exactly. The market is exclusively pricing in the immediate, staggering surge in transaction frequency we're seeing on the tape right now.
And the tape is wild today. Let's actually look at the real-time performance. HOOD is currently trading at $89.72.
That's up $10.63 in a single session.
Just massive. To frame that volatility for you, the 52-week range has a floor of $39.21 and a ceiling of $153.86.
Right in the middle.
Yeah, we are carving out a massive recovery swing right in the middle of that historical range.
And the momentum signals backing up this swing are aggressive, like really aggressive. We're looking at a messy D of 4.01.
Which is a strong buy.
Firmly cements a strong buy signal on the daily time frame. But what really stands out to me is how the stock is behaving relative to its moving averages.
Oh, right. The 50-day and 200-day?
Yeah. It's trading significantly above the 50-day, which is sitting at $75.33. And it's well above the 200-day at $107.39.
Wow.
That alignment suggests that algorithms and, institutional trend followers are treating this not just as a short squeeze.
But as a real reversal.
Right. A legitimate, anticipated reversal from its prior long-term downtrend.
Well, the order flow definitely confirms that institutional presence. The volume today is 72.7 million shares.
That's a huge print.
It is. For context, the 30-day average is only 31.6 million. You just don't more than double average daily volume just from retail traders buying fractional shares on their phones.
No, you don't. That kind of liquidity requires heavy institutional participation.
And we saw that play out this morning, actually. There was an early dip right off the open, and the order book showed massive, aggressive absorption right in the $81 to $83 range.
I saw that. They were stepping in big.
Every time sellers pushed it down toward $81, block orders stepped in and just swept the ask. It looked like institutions were fiercely defending that level, establishing a new higher floor.
Yeah, and when you see VWAP algorithms and institutional buyers stepping in that aggressively after a gap up, it indicates something specific.
What kind?
It means they're modeling a significant forward revenue boost from this PDT rule change. They are establishing positions right now because they expect the coming quarters to really reflect that increased PFOF velocity.
I hear that, but I'm looking at the RSI right now, and I have to push back a little on the sustainability of this current leg.
Fair enough. The RSI is hot.
Yeah, the 14-day RSI is sitting at 80.48. That is deep into overbought territory. It feels like a textbook FOMO rally, fear of missing out, where retail momentum chasers are just buying at the absolute top of a news cycle.
Completely ignoring the technical exhaustion.
Exactly.
Your skepticism is dead on there. And RSI at 80.48 indicates severe near-term overextension. The immediate resistance level is sitting right at $91.18, which it basically tested at today's peak before pulling back.
Right.
Historically, when you see an RSI spike this aggressively into the 80s, you run into severe technical exhaustion somewhere around the $95 mark.
The buying pressure just runs out of steam.
It simply depletes its immediate capital reserves.
So anyone hitting the buy button at $89 is essentially betting that this specific news cycle is powerful enough to, break standard technical gravity.
Or they just have a much longer time horizon and they don't really mind carrying the immediate drawdown. Because, look, a pullback from $89 wouldn't inherently break the bullish thesis.
It wouldn't.
No. If HOOD cools off and consolidates back down to test that 50-day moving average at $75.33, that's actually a really healthy structural development.
Oh, I see. It builds a base.
Exactly. It allows the moving averages to catch up to the price action. Parabolic moves that don't consolidate, those are the ones that end in structural collapses.
That makes a lot of sense. So the price action tells us how the market is reacting to the SEC headline in real time. But to figure out if HOOD can actually defend an $89 valuation post-consolidation, we have to look under the hood.
No pun intended.
Right. We have to look at the internal fundamentals. We have fiscal year 2025 data compared against 2024, and the growth metrics are, honestly, they're staggering.
They are undeniably strong. Sentiment only carries a stock so far.
Right. Eventually, the balance sheet has to justify the multiple.
Right. And Robinhood's recent performance does a lot of heavy lifting in that regard.
Let's pull apart the income statement for a second. Fiscal year 2025 total revenue came in at $4.47 billion. That's a massive 52% year-over-year jump from 2024's $2.95 billion.
Huge growth.
Yeah, and net income surged from $1.41 billion to $1.88 billion, which pushed diluted EPS from $1.56 up to $2.05. You just don't see 52% top-line growth in mature brokerage platforms.
You really don't. But it's the underlying drivers of that revenue that make it so compelling. This isn't just a volume spike, it's a structural improvement in their margins.
How so?
Well, you have to look at the balance sheet to see the stability beneath the growth. Total assets expanded from $26.19 billion to $38.14 billion.
Wow, okay.
Yeah, and total equity pushed up to $9.15 billion. But most crucially, for a broker operating in, high volatility environments, their cash and equivalents are sitting steady at $4.33 billion.
So they are heavily capitalized.
Extremely.
So how are they driving $1.5 billion in new revenue in just 12 months?
Two primary engines. First, their gold subscription model. They've hit 4.2 million gold subscribers.
That's a lot of recurring revenue.
Highly predictable recurring revenue. But more importantly, it locks users into their ecosystem. Gold subscribers get higher yields on uninvested cash sweeps and lower margin rates, right?
Right.
So that incentivizes them to consolidate their outside capital onto Robinhood's platform. It's just a massive liquidity moat.
That makes sense. And the second engine?
The crypto market recovery.
Ah, of course.
Yeah. We know that crypto transaction fees carry significantly wider margins for Robinhood than standard equity PFOF. With digital assets catching a major bid over the last year, Robinhood basically captured a disproportionate share of that retail volume.
And that flows straight down.
Exactly. It's a high-margin revenue stream that flows directly to the bottom line, significantly boosting that EPS figure you mentioned earlier.
Okay, so let's weigh what we have so far.
Yeah.
We have the SEC completely removing the regulatory ceiling on retail day trading,
Yeah.
which theoretically explodes their PFOF volume.
Yep.
We have institutional block buying defending the low 80s. We have 52% revenue growth, a massive cash position, and highly profitable crypto volume. By every conventional metric, this sounds like an absolute juggernaut.
Which brings us to the trap.
Right. Because despite everything we just laid out, the advanced valuation models are screaming that this stock is highly overvalued.
And this is the critical distinction between a great business and a great investment.
Yeah.
You can have a company firing on all cylinders, but if the market has already priced in the next 5 years of perfect execution, your upside is severely capped. Currently, Robinhood is trading at a PE ratio of 42.6x.
That's a premium multiple, even for the tech sector.
It's an incredibly demanding multiple. It requires flawless forward execution to sustain. And when you run the DCF models, the discounted cash flow models from sources like Investing Pro and Simply Walsian, the math gets very sobering.
What are they saying?
Well, these models factor in that 52% growth rate and the SEC catalyst, yet they still calculate the stock is 30% to 46% overvalued at current levels.
Ouch.
Yeah, they peg the true fair value somewhere between $49.48 and $71.83.
So the quantitative data is telling us that at $89, we are paying a massive premium over intrinsic value.
A massive premium.
And that mathematical reality makes the next piece of data from our sources incredibly alarming. We are seeing massive, coordinated insider selling at these levels.
This is the variable that changes the entire complexion of the tape.
Just days ago, on April 6, right before this current massive run really peaked, CEO Vlad Tenev offloaded $26.1 million in shares.
That's a serious exit.
And it's not just him. The chief technology officer and the chief financial officer are also aggressively rotating out of significant positions. If the SEC rule change is going to generate a historic windfall for the company, why is the entire C-suite hitting the bid?
It's a great question, and it forces you to look at the psychology of liquidity and how the mechanics of institutional exits actually work.
Break that down for us.
If you are a CEO holding tens of millions of dollars in equity, you have a distinct mechanical problem. You cannot sell that size into a quiet, illiquid market without severely depressing the stock price against yourself.
Because there's no one there to buy it.
Exactly. You need a massive influx of eager buyers on the other side of the order book to absorb your shares without causing slippage.
You need a distraction. Or in this case, a massive, highly publicized SEC headline that brings every retail trader in the country rushing into the stock.
The headline creates the liquidity wave. Retail traders see the $25,000 PDT rule vanish. They see the stock up 13%, the RSI hits 80, and the FOMO kicks in.
They just flood the ask.
Meanwhile, insiders and algorithmic trading desks utilize that exact surge in retail liquidity to offload their positions at peak valuation multiples.
Wow, it feels like we, the retail traders, are being invited to the most exclusive party of the year, but the hosts of the party are quietly slipping out the back door with the silverware.
That is a perfect analogy.
Why do retail traders always get trapped in these setups?
That dynamic is exactly why retail historically gets caught holding the bag at cyclical tops. The retail trader is buying at $89 because they are emotionally invested in the narrative of the stock hitting $100.
Right, they see the momentum.
But the CEO is selling at $85 or $89 because they are intimately aware that the DCF models are accurate and the fundamental fair value of the business is closer to $60. They are locking in the premium while the liquidity allows it.
So we have these two completely opposing forces acting on the stock right now. It creates a massive divergence in how analysts are actually modeling the future. Let's look at the broader Wall Street consensus because it reflects exactly this split.
It really does. The overall consensus rating is sitting at an outperform, which is a 1.9 on the standard 1 to 5 scale. So there is institutional belief in the underlying business model.
But the price targets are completely fractured. The average target is $117.36.
Okay, so upside there.
Right. The highest, most optimistic target sits at $180. but the bearish floor is all the way down at $70. You have a $110 spread between the bull and bear targets on a stock that's currently trading at $89.
A spread that wide tells you that the analytical community has no idea how to accurately weight the variables here. The models are basically breaking down because the inputs are unprecedented.
So let's synthesize those variables. Let's weigh the bullish thesis against the bearish reality.
Sure. On the bullish side, you are factoring in a permanent structural increase to their daily active user engagement. The removal of the PDT rule doesn't just bump revenue this quarter.
It sets a new floor.
In theory, it establishes a permanently higher baseline for transactional volume. Add to that the sustained margins from the 4.2 million gold subscribers, the continued resilience of the crypto markets, and their aggressive international expansion.
Right, Indonesia and the UK.
Exactly. Robinhood's entry into the UK and Indonesia opens up entirely new retail pools that haven't even begun to hit the income statement yet.
If they successfully scale the UK and Indonesia, a 42 PE multiple might actually look cheap in retrospect. But the bear case carries significant structural gravity too.
It does. The bears look at that same PE of 42.6 and see zero margin for error. They look at the RSI at 80.48 and see immediate technical exhaustion.
And the insider selling.
Most importantly, they look at the C-suite capital flight. The bear argument is that the SEC rule change provides a short-term sugar rush of retail volume.
But once those unrestricted day traders inevitably churn through their capital,
The volume will crater. And when the volume craters, the revenue misses estimates, and the stock rapidly reverts to its $50, $60 fair value.
so bring this back to you, the listener. What is the actual outlook here? If you're looking at your screen right now, how do you contextualize this data across different time horizons?
Over the next few weeks, you have to expect extreme volatility. This is a real battleground level. If the algorithmic volume can hold a daily close above that $90 resistance, the path of least resistance technically opens up toward $105.
But if it doesn't hold?
If that institutional support we saw at $81 breaks down, the stock will slide rapidly back to test the 50-day moving average at $75.
And on a longer, multi-quarter horizon?
Long term, it all comes down to user retention. Does the removal of the PDT rule turn Robinhood into a daily sustained utility for its users?
Or does unrestricted day trading just accelerate the rate at which retail accounts blow up and leave the platform?
Exactly. That behavioral data, combined with the execution of their international rollout, will dictate whether this company is ultimately worth $180 or $70.
As always, we have to make it explicitly clear that this deep dive is an analytical debate based on SEC filings, order flow data, and market mechanics. It is absolutely not financial advice.
No, definitely not.
The market is a highly dynamic environment,
Yeah.
and you have to manage your own risk parameters.
Especially in setups with this much conflicting data, blindly following a headline without understanding the underlying valuation models is, well, it's how capital gets destroyed.
Which leaves us staring down a massive catalyst right around the corner. Robinhood's Q1 earnings report drops on April 28, 2026.
That's the big day.
The actual quarterly numbers are one thing, but the forward guidance is what will move the market. Will management revise their full-year revenue targets upward to reflect a permanent new reality of unrestricted retail trading?
Or will the multi-million-dollar insider selling we just discussed prove to be the ultimate leading indicator of a looming revenue miss?
The tape on April 28th will settle the debate. We'll find out whether the retail momentum chasers or the exiting executives had the right read on the data.
It's going to be fascinating to watch.
But I want to leave you with one final thought to mull over, something the market isn't really even discussing yet. The SEC just removed the strict financial guardrail of the $25,000 day trading limit.
Right.
If Robinhood's newly unleashed users start racking up massive, rapid losses because they're overtrading, how long until the regulatory spotlight shifts away from account minimums and directly onto the psychological design of the app itself?
Oh, wow.
If the financial barriers are gone, could behavioral regulation, scrutinizing Robinhood's gamified interface, be the next massive headwind this company faces? Think about how that changes the long-term thesis. If it were your money, do you ride the regulatory wave or do you follow the CEO out the door? We'll see you on the next deep dive.